A business owner, whether it is a company or a natural person, usually has to incur a number of expenses to be able to run his or her business. To generate income, whether it is through the sale of goods or through the rendering of services, certain expenses need to be paid. Examples of these types of expenses include salaries and wages, marketing and advertising, trading stock that you purchase, legal expenses, insurance, accounting fees, admin costs. I'm sure you can think of a lot more. The question is, what are we going to do with these expenses that have been incurred by a taxpayer when we calculate their taxable income for normal tax? Before we look at the impact of deductions on our taxable income calculation, you first have to make sure that you understand the following principles. Firstly, a deduction represents an outflow of cash or other assets. Think about the journal entry that you have to write to record the transaction when advertising expenses have been paid. You will debit the account marketing expenses, which will influence your statement of profit and loss, and you will credit the account bank and cash. That credit of bank and cash represents an outflow of cash. In other words, a reduction in our assets in the statement of financial position. Second principle is that expenditure and losses are deducted against income as defined. Because we reduce income when we deduct expenditure or losses, this decreases our taxable income and in turn, of course, decreases the normal tax that SARS will be able to collect. That's why you will see a lot of rules and limitations when it comes to deductions in the Income Tax Act. Number 3, remember that expenditure deductions represent an outflow of cash or other assets. Do not confuse amounts that are received by or accrued to, like sales, turnover, fees for services rendered, etc., with expenses or deductions. Amounts that are received or accrued, in other words, where an amount represents an inflow of cash or other assets, has to be measured against the gross income definition, and these amounts will increase our taxable income. Finally, if our taxpayer is a registered VAT vendor, we also need to account for any possible VAT implications. A good rule of thumb when dealing with integrated questions is to kill VAT, in other words, deal with any VAT consequences first, then kill normal tax, in other words, determine the effect on taxable income of the transaction that you are dealing with, after adjusting for any possible VAT consequences, and then finally kill CGT. In other words, consider the possible capital gains tax effect of the specific transaction that you are busy with. Deductions of expenditure and losses reduce taxable income, and we will indicate it with brackets in our framework for the calculation of taxable income. Remember, expenditure or losses are deducted against income and ultimately reduce our taxable income.